Good day, my name is Anna Cherkizova and I'm a freight editor at Agus Media based in Singapore. With ongoing disruptions in the Middle East continue to reshape global shipping patterns, understanding their impact on tanker markets has never been more important. In this short podcast, I'm joined by my colleagues Sean Louis, senior crude tanker freight reporter, and Sureka Ilangavan, clean tanker reporter. And we will discuss the latest development in the Middle East, how they are affecting crude and clean tanker trade flows, freight rates, vessel demand, and the broader outlook for tanker markets. Hi, Sean. Considering the Middle Gulf is the world's largest oil exporting region, how has the war reshaped freight dynamics for tanker vessels in the 3 or so months since the US and Israel war against Iran began on the 28th of February?
Thank you, Anna. Well, from my regular conversations with the many market participants that I speak to across shipbrokers, charterers, ship owners, all have concurred that the war has upended shipping as most of them have known it. Freight rates have surged to levels not seen in many years, and trade routes, which were what most shipping market participants had thought was the mainstay for tankers, took a very unexpected turn since 28th of February. In the first week since the war began, the Suezmax freight rate on the bellwether Mideast Gulf to East Asia route surged by almost 200%. The Aframax rate on the route jumped by about 170% over the same period. There was immense uncertainty amongst both charterers and ship owners as chaos ensued. But amongst the chaos, some ship owners jumped on the opportunity to fix cargoes out of the region, asking for significantly higher rates, while most decided to remain cautious and stay away. At the same time, oil prices surged, which pushed freight prices for bunkers higher. Following this, ship owners also started to push for higher rates, as voyage costs started to increase, which led to a spillover rise in Aframax freight rates in Southeast Asia, although that rise turned out to be a more gradual one. Along the way, the market was constantly reacting to news, ranging from attacks on commercial vessels and hints of potential peace deals, which mostly didn't materialize. All this culminated in significant volatility in freight rates, which kept market participants largely on edge. Meanwhile, real and substantial threats to shipping itself began to surface as Iran tightened its grip on vessel transits through the critical Strait of Hormuz, launching attacks on vessels who failed to comply with the blockade. Apart from also laying mines in the strait to deter vessel transits, Iran also set up a body called the Persian Gulf Strait Authority, PGSA for short, in the middle of May as a means of tightening its grip on vessel transits through the strait. As at the 2nd of June, PGSA said that 300 non-Iranian vessels had reached out to obtain permits. As these events unfolded, countries worldwide began scrambling to safeguard against a potential crude supply shortage, one that could have had severe consequences and possibly brought entire economies to a standstill. Towards the end of April, some countries, including India, Malaysia, Thailand, and the Philippines, engaged Iranian authorities to request permission for their vessels or vessels loaded with their cargoes to depart the strait. While these initiatives eventually proved to be somewhat successful, it also prompted important questions about the right to safe and unimpeded transit through international waters for ships, especially through critical waterways like the Straits of Hormuz and Malacca under United Nations conventions. Meanwhile, key Mideast Gulf crude producer Saudi Aramco of Saudi Arabia also turned to its East-West pipeline to divert crude exports, allowing its customers to now load at the Red Sea port of Yanbu. In response, Argus launched a series of new assessments from Yanbu across 3 vessel sizes: Aframaxes, Suezmaxes, and VLCCs. We also included rates to West Coast India from Yanbu and later launched a VLCC assessment from the Gulf of Oman to East Asia.
Awesome. Thanks, Sean. And we are quite confident that these new rates could become a benchmark further. Sean, and looking at the Asia-Pacific market, how have Asian refiners reacted to Middle East supply disruptions?
Well, Other Asian refiners also began to look westwards for alternative sources of crude oil, for example, from the US Gulf. This pivot towards longer haul voyages lifted ton-mile demand for crude tankers, even in the absence of voyages from the Mideast Gulf. Several tanker ship owners recently cited this trend as the key driver behind their record profits in the first quarter of 2026.
Thank you, Sean, for sharing your views. Now, 3 months on, the key questions over the situation in the Strait of Hormuz remain largely unchanged. Which vessels are managing to pass through, how they are doing so, how many are getting out, and how long this situation is going to last. Sureka, looking back to the period before the conflict, what have been the most significant changes in the CPP tanker market since the outbreak of hostilities in the Middle East?
Thank you, Anna and Sean. The US-Iran war has indeed had clear and immediate impact on both freight rates and trade flows. In the first weeks after the war broke out in late February, freight rates for clean tankers in the Mideast Gulf surged sharply. The Japan-bound LR2 rate from the Mideast Gulf had jumped by about 117% within a week, while the LR1 rate on the same route roughly doubled from pre-war levels, reaching highs last seen in April 2020. This spike was driven by a combination of heightened risks, a sharp increase in additional war risk premiums, and rising bunker costs on the back of broader crude market volatility. However, the impact extended beyond freight flows. Trade flows were also disrupted. The Mideast Gulf is a key supplier of naphtha to East Asia, and shipping fixtures out of the Mideast Gulf had dropped dramatically, with very few cargoes moving directly through the Strait of Hormuz in the initial phase of the war. Instead, flows were rerouted, with some activity shifting to loadings from the Gulf of Oman or West Coast India instead, to avoid transiting the Strait of Hormuz. Over time, producers and traders adapted by introducing workaround logistics, particularly through ship-to-ship transfers in relatively safer waters outside the strait. While these measures allowed some exports to continue, capacity remained limited. Volumes moving out of the region remained significantly lower than normal pre-war export volumes, unable to fully replace traditional routes that involved having to transit through the Strait of Hormuz.
Thank you, Sureka. And has the conflict had a noticeable impact on the Asian CPP tanker market? And if so, what changes have you seen?
Although freight rates in the Mideast Gulf have been the focal point since the outbreak of the US-Iran war, the impact also filtered through to the Asia-Pacific clean tanker market, primarily driven by market sentiment, cost pressures, and vessel positioning rather than underlying demand. In the immediate aftermath, freight rates across Asia-Pacific moved higher in tandem with the sharp spike in the Mideast Gulf. For example, in Northeast Asia, the South Korea to Australia route climbed to a 2-year high by early March compared with pre-war levels. This was not driven by a sudden improvement in regional demand. In fact, demand in Asia-Pacific was relatively subdued. The main catalyst was rather the sharp increase in freight rates in the Mideast Gulf, which then had a knock-on effect on the Asia-Pacific clean tanker market. The biggest driver of freight movements in Asia-Pacific has really been external pressure from the Mideast Gulf. Singapore bunker prices also surged sharply in early March, reflecting both disrupted trade flows and increased demand from vessels rerouting away from the war zone to refuel at safer hubs. Operational factors have also played a role. As more vessels were diverted or repositioned to avoid high-risk areas, tonnage supply tightened in parts of Asia, lending further support even in markets that were not directly exposed to the war. At the same time, the expectation that more ships would call at Singapore for bunkering added pressure to local fuel supply and contributed to the upward momentum in freight rates.
Thanks to the both of you for sharing your thoughts and expertise today. And what are your views on what comes next? How do you see the tanker market evolving from here? And what are the key factors that could shape market directions in the near term?
Well, right now, questions relating to the longer term context seem to be gradually surfacing as market participants begin to accept and prepare for a longer dragged out war in the region. What's going to happen if and when the war ends? Will the market be able to return to normalcy after such a severe disruption? And if so, how long would such a runway be deemed as reasonable? Unfortunately, these questions do not have clear answers at the moment, and the general notion from the market for now is to just go with the flow, as one shipbroker said, which also means that the market, not just in shipping but across all relevant commodities, will need to be constantly kept on its toes so that they may respond nimbly to any developments, regardless positive or negative.
Yeah, it's true. Thank you, Sean. So now we are all going with the flow. Thank you, Sean. Thank you, Suraka, for sharing your perspectives. It's been a great discussion, and we hope our listeners found it insightful. And thanks so much to our audience for joining us today. Anna Cherkizova, Sean Louis, and Suraka Yalangavan, Argus Media.